If you think saving 15% maxing your 401k and dumping everything into index funds is enough to reach financial independence, you're probably the guy it's quietly screwing the most. Because here's what actually happens. You grind, you skip the fancy coffee, you automate your contributions like a robot, you tell yourself you're doing everything right. Then you look at your net worth chart after 5 years and it's fine, not life-changing, not I can walk away from the 9 to 5 fine. Meanwhile, you watch some other dude your age post a screenshot of his brokerage account that just 3x'd in 18 months, and you think he must have gotten lucky or he's gambling. But that's not quite right. The real game isn't about luck or gambling. It's simpler and more brutal than that. The gap between how investing is supposed to work and how it actually works is massive. You were handed an incomplete rulebook, the same one every finance guru and book repeats, and nobody told you the rest. They just let you compound slowly while the market moves on without you. Here's the rule nobody teaches you in your 20s or 30s. Following the fundamentals is necessary, but it's not sufficient. You also have to be seen as the guy who understands the real drivers of price movement by the right people at the right times. And nobody explains this because it would sound like you're trying to game the system. But it's not gaming. It's just how groups of humans, retail, institutions, even algorithms trained on human behavior actually price assets and create opportunity. Let me show you how this plays out. Two guys, same age, same salary, same starting capital of $30,000. Both read the same books, both dollar cost average into the same broad market ETFs every month. Identical fundamentals. Guy A keeps a private Google Doc of his investment thesis for every position he adds. 3 bullets on why he bought, what would make him sell, and the catalyst he's waiting for. He never shares it publicly. Guy B does the exact same work, but he also posts a short, clear thread on Twitter/X and a quick update in a couple of serious investing discords every quarter. Nothing flashy. Just, here's what I'm seeing and why I'm still holding. Fast forward 18 months. A macro catalyst hits. Interest rate pivot, sector rotation, whatever. The asset both guys own jumps 40% in 6 weeks. Guy A watches his account go up and feels smart. He sells half at the top because his private thesis said to. Good move. But here's what actually happened next. Institutions and big money accounts were scanning public sentiment and thesis threads for conviction signals. Guy B's name and thesis showed up in 3 different places. A hedge fund analyst DM'd him for color. That conversation led to an invite to a private Slack where real-time flow information moves. Guy B got the exact exit timing signal 2 days before the reversal. He sold at the absolute peak and rotated into the next leg up. Guy A made money. Guy B made life-changing money on the same underlying move. This is the part that breaks guys because both did the same good work, both read the same charts. But invisible conviction gets treated like it doesn't exist, and most retail investors' work stays completely invisible. Here's another thing that happened. You find a small cap name or a new technology trend early. You do the deep research. You put real money in, but you keep it quiet because I don't want to shill. 6 months later, the same idea goes viral. Everyone suddenly knew about it. The guys who were publicly mapping the thesis early get quoted, interviewed, and, most importantly, invited into the rooms where the next wave of capital is being allocated. You're still holding the bag while they're already rotating. Credit didn't flow to the person who did the best analysis. Credit flowed to the person who communicated the analysis at the right moment. This isn't fair. But fairness isn't the system you're operating in. Visibility is the system. You can be right about the fundamentals and still lose the timing game. There's a deeper problem most guys miss. You think you're being judged on your returns, your Sharpe ratio, your spreadsheet, but that's not how real opportunity works. The market isn't keeping a perfect ledger of who did the homework. Big money, smart money, even the algos are keeping a feeling. A vague sense of who has edge, who sees around corners, who's worth listening to when they say this is the one. That feeling gets built from fragments. The thread you dropped 3 months ago that aged well. The calm update you posted during a minus 20% drawdown when everyone else was screaming. The time you admitted you were wrong in public and showed the updated thesis. These fragments add up to a story. And the story determines whether opportunity finds you or passes you by. Now let's talk about relationships. This is where a lot of guys shut down because it sounds like networking, and networking sounds fake. But relationships in the market aren't about being fake. They're about being known by the right 10 to 15 serious people. When a real edge appears, a catalyst, a filing, early data, it doesn't get announced on CNBC first. It moves through small circles of people who trust each other. Trust doesn't come from your account size. It comes from dozens of small interactions. The question you asked that showed real depth. The time you shared a non-obvious data point without asking for anything in return. The way you handled a losing position without panic posting. You don't have to be friends with everyone. You don't have to be loud. But you do have to stop being a ghost in the machine. Because decisions about capital, where it flows next, get made by humans, and humans move money toward people they know. This feels obvious when I say it like this, but watch how you actually behave with your investing. Do you talk to anyone about your real thesis? Do you ask for pushback from people sharper than you? Or do you just log in, buy, set alerts, and disappear? If it's the second one, you're not being disciplined. You're being invisible. Here's the thing nobody warns you about in your 20s and 30s. Some guys are better at this than you. Not because they're smarter or have more money, but because they're more socially aware in the investing sense, or someone showed them the game earlier. And that unfair advantage compounds like crazy. You don't get to opt out of the perception layer and still win the FI race. There's another dimension nobody talks about: loyalty. Not the fake diamond hands meme kind, the real kind that gets remembered. When your thesis gets tested and the position is down 35%, do you stay quiet or do you post the updated reasoning? When a friend in the group is struggling with a bad call, do you help dissect it or do you just focus on your own book? When blame is being thrown around after a sector blow-up, do you throw someone under the bus or do you own your part? These moments seem tiny at the time, but they accumulate. They build reputation. And reputation in the right circles is currency that gets you early, looks at the next opportunity. The guys who reach FI faster aren't always the best stock pickers. They're often the ones other serious investors want in the room. The ones who made someone's research easier once. The ones who didn't disappear when things got ugly. Let me tell you what happens if you ignore all of this. You keep doing the right things for years. You stay disciplined. You keep your head down. You compound at 8 to 10% like the textbooks say. And then one day you're 37, still trading your time for money, and you realize you've been passed over by the market again and again. The bitterness starts. You stop sharing ideas. You stop engaging. You go full silent mode and convince yourself you're protecting your edge. But bitterness doesn't protect your edge. It erases your compounding. And here's what most guys miss. When you disengage, you stop learning the things that actually move the needle. The most valuable information doesn't come from earnings reports or 10KS. It comes from being in the conversation when real capital is deciding where to go next. From watching why certain narratives get funded and others die. From seeing how conviction actually forms in real time. If you're not present for those moments, you're investing blind. So what do you actually do? First, stop waiting for the market to notice you. No one is coming to discover your brilliant private thesis. Institutions and smart money are busy. If you don't make your conviction visible in the right places, it stays invisible. This isn't shilling. This is documentation. Post the thesis, update it publicly when it changes. Make sure the people who move capital know you exist and you think clearly. Second, build real relationships with a small group of guys who are actually serious. Not the meme crowd, not the gamblers. Help them when you can. Ask smart questions. Be the guy they remember when a real edge appears. This isn't networking. It's just not being a ghost in a game that runs on trust. Third, understand how decisions actually get made in the market. Who has the flow information? Who influences sentiment? This isn't manipulation. It's not being naive. If you want to catch the next leg early, you need to know who can give you the signal and make sure they understand why your thinking matters. There's one more thing that matters more than almost anything else: timing. You can do everything right and still get nowhere if your timing is off. You can post the perfect thesis the week after the move already happened. You can ask for capital or a connection right when everyone is in risk-off mode. Context is everything. Most guys ignore context completely. They think good analysis should speak at any volume at any time, but it doesn't. The same thesis dropped in January might get institutions interested. Dropped in July during earnings panic, it dies. And here's what makes timing even more brutal. Proximity to success matters more than your individual contribution. If you're in the conversation around a name that suddenly runs, you get pulled into the next wave even if your position was small. If you're isolated during a blowup, the stain lingers even if it wasn't your fault. We remember associations, not details. So when the market recalls that big winner, it remembers everyone who is in the room. Proximity creates perception. Perception creates opportunity. Here's the last thing, and I want you to really hear this. You weren't stuck because you're not smart enough. You weren't passed over because your analysis sucks. You were evaluated on a scoreboard you didn't even know existed. Fundamentals matter. But so does visibility. So do relationships. So does timing. And nobody told you to track those things. They just assumed you'd figure it out while grinding. Most guys spend years being angry about this, wishing 8% compounding and time in the market were enough. But wishing doesn't change the game. Understanding it does. And then you decide what you're willing to do. You can keep doing exactly what you're doing and hope the slow path eventually gets you to financial independence. Or you can make small, consistent adjustments that give you an actual shot at the fast lane. Either way, the market doesn't care. It just keeps moving. And it will move past you if you let it. So the question is simple. Are you ready to stop being invisible? Drop a comment with the one thing you're going to start doing differently this week. Whether it's posting your first public thesis, reaching out to one sharp investor, or mapping the next timing window, let's make this the year you actually break the cycle. I'll see you in the next one.